Pretty sure you have. Yep.
Yeah, we're good now.
Okay. Excellent. Welcome back. Good to see you, sir.
Thanks for having me again.
Yeah. Lawrence, good to see you again.
Great to see you, Sean, and good to see you again, Simon.
Yeah, so it's been 7 months since we spoke. I was just sort of jogging my memory for, I think it was actually the day that the markets really tanked, both traditional markets and the crypto markets. I remember getting off the call with you guys, and yeah, we were heavily down. So we're going to endeavour to cover a number of subjects here for the audience today. But really, I wanted to kick it off with what's extremely topical at the moment. There's been a lot of SEC action against some major players in the crypto space. So I'd love to get your thoughts on what you think is driving that. Maybe Simon, if you could kick off there for us, and then I'll throw it over to you, Lawrence.
Yeah, I mean, so the background on the SEC action is that if you look at the last wave of innovation, so we have lots of waves in our crypto industry. And for those will probably be very familiar that in 2017, we entered bubble territory because people were finding a way of issuing investments and not complying with any securities laws. And most people were considering it an investment. And if they consider an investment, then the SEC takes the stance that there needs to be regulations and controls around investments that are sold. They do deal with securities mainly. And we, at Bank to the Future, we've been dealing with this for approximately 10 years. So we were the first securities business in the crypto sector. And we got disrupted in 2017. We sell equity, we comply with securities laws. And then all of a sudden, all of our clients started issuing tokens and not complying and not bothering to comply with securities laws. And so, it creates this really interesting dynamic. And if we went on the trajectory that we were going to go without the SEC getting involved, and I'm not really making an opinion about whether they should or shouldn't get involved, but if they did, then what was about to happen is the entire public markets were about to be disrupted because public companies were starting to put blockchain in their name just so they could pump their share price. They would start to issue tokens and then end up with this very valuable asset, or maybe not so valuable asset. And all of a sudden, people were going to start delisting from exchanges and listing on token exchanges so that they could have more favorable conditions in order to raise capital. And so really, it was flying in the face of 1930 Security Act was when it first came about. And it was trying to unwind about 90 years of securities laws. And so what we've seen is that then they did a crackdown. They take out a few high-profile figures. Everybody pays a few fines. And then it tends to cool down the market and people start doing it outside the US. Overseas regulators start to put together their form of regulation so that they can try and compete in a market where every country's looking for new jobs, new innovation. But then we had this next wave that came along, which is DeFi, which is where rather than issuing a token and restricting US investors, you now have to do everything on chain and decentralized. And therefore, US investors can participate. But now, if this continues on its trend and they don't have a crackdown, then this is going to start disrupting all of the markets and people are going to do everything in a decentralized fashion. And so SEC starts to look at the next round of what they can do because US purchasers are trading peer-to-peer in these what might be securities. And they've got to try and maintain orderly markets and control over such matters. So we just get these waves where of innovation being disrupted.
A hell of a lot to unwrap on this topic, and we'll come back delve into it a bit deeper. But overall, Lawrence, what are your thoughts on this?
Oh, look, I concur. To put some numbers against it, the publicly traded companies are now sitting on, I think, $6.7 odd billion of Bitcoin, based on the last report. So clearly, the SEC is now stepping in because now you've got indirectly exposure through the key stock markets in the US to Bitcoin. So they're clearly just now stepping in and starting to clean things up. I think it's a positive move. I think it is a recognition that the digital asset space is starting to move into the mainstream. I don't necessarily know how valid some of the actions are against companies like BitMEX and indirectly EOS as well. But let's see. I have a feeling that there's still going to be some more action to come. I think the ICO market still needs to be cleaned up quite a bit. The lack of regulations there is still allowing for mum and pop investors effectively to get ripped off by certain unscrupulous parties. But there is amongst those ICOs also a lot of quality, and I sort of see what's happening in the crypto market as being a cauldron of innovation. So some of the areas like Simon mentioned in DeFi with automated lending that's coming out. I mean, it's brilliant. The collateral that's currently being used on those platforms, it's all decentralized. They're using obviously the cryptocurrencies, but in the future, that technology, those processes can be migrated into into regulated DLT-backed markets, and equally use collateral such as digital asset-backed real-world assets, property, gold, etc., to basically replace the lending that we're seeing from financial institutions today, and have those markets be more directed by actually the owners or the holders of capital, which are all the big funds. So yeah, I see it as a very positive move.
Okay. Simon, you did a absolutely brilliant interview with Max Kaiser on RT. He called you a futurist in the introduction there, something I strongly agree with. We're obviously at a pivotal moment in human history on a number of fronts here. It's been 7 months since we spoke. You were talking about these central bank issued digital currencies at that point. Maybe update us on your thinking of where we're at and what's next.
Yeah, so I think central bank digital currencies are going to be used in order to, I think we're going through a 1944, 1971 style moment. This pandemic has meant that the governments have had to chuck all of their fiscal policy, all of their monetary policy, all of their quantitative easing, all of their central bank balance sheets. And I think we're reaching the end of a debt cycle. And once we hit the end of a debt cycle, you tend to get these moments where we go through radical monetary renegotiations. I think we're at that point where in the next 3 to 5 years, we're going to have a very, very different form of money. And all of the telltale signs and all of the signals are there that every central bank is getting ready for that. So, an example is the Bank of England has been reaching out to all of its member banks and asking them what the impact on their technology will be for negative interest rates. And so they've got to prepare themselves for the technological impact of negative interest rates on their systems. So, governments want to punish savers. They don't want you to save. They want you to be in debt. The economy is driven by debt, and growth is driven by debt. So therefore, saving is a bad thing. That's why during the last Great Depression, the end result was making gold illegal because too many people were hoarding gold. So, certain countries don't like savings. They're like that. So the inevitable next move is that we have an over-leveraged financial system. The governments have outsourced the ability to create money to the private banking sector, and the private banking sector have created a digital representation of the government's currency that's backed by debt. Now, I think that we're going to have that debt and that leverage replaced by a central bank digital currency, and it's going to be introduced into the economy in 2 forms. And I think every country is going to do the same. And I think we're going to have global ones issued at the IMF, World Bank level, and Bank of International Settlements. And what I think we're going to see right now is an over-leveraged banking system that essentially is the world's largest regulated Ponzi scheme I call fiat currency. When it gets to an over leverage point, because of the social unrest at the moment, rather than allowing taxpayers to pay it through a bailout, or depositors to pay it through a bail-in, or pensioners to pay it by repackaging the product to like they did in the last financial crisis and selling it to your pension as investment grade, I think they're going to let the banks go bust, and they're going to issue you a central bank digital currency on an app that is proportionate to the amount of deposit you had at that bank. Then I think the central bank digital currency will be used to take all of the bad debts that needs to be re-auctioned. And I think everybody's going to receive stimulus as well as an incentive to download this app, which means that central banks are now in the business of retail banking, and they're going to outsource all the customer service to financial technology companies. And you're going to have API-based banking and a radical reform of the monetary system. Now, some people might say we already have digital currency. Isn't all money digital already? Which is true, but it's backed by debt. If the central bank issues it or the government issues it directly, then you're deleveraging the economy. It's non-inflationary if you're replacing one form of money with another form of money. And I think in the next 5 years, all of the major economies are going to be sat around, and it's already starting, innovating the central bank digital currency. And it's going to take us in a really, really, really nasty direction in terms of the effect it has on privacies, personal freedoms. And it's really going to push the use case for what Bitcoin was designed to do, to give you the ability to own your own money, spend your own money, and have a money policy that's fixed and can't be changed based upon the whims of a few people sat around a table.
Yeah, let's unpack this a bit. Lawrence, have you got some thoughts?
Yeah, I mean, Simon, do you think, in terms of how this plays out, do you see sort of a similar scenario that played out in 2008, where, all of a sudden overnight, Bear Stearns all of a sudden has an issue, and then, the next thing it starts to sweep through the whole sort of banking system, or the counterparty risk comes home to roost. And at that point, the government sort of steps in. I mean, right now, depositors are protected by, a 25% guarantee on their deposits through, in the US through the federal insurance plan. But do you think, to stop a run on the banks, it will be a case where the governments will be ready and they'll just step in and they'll say, well, we guarantee 100%, we'll just replace that. Your deposits will be replaced through a digital currency issuance?
Yeah, I think the second. So the first thing is FDIC. FDIC, which is the insurance for bank deposits in the US, it insures approximately $250,000 or guarantees $250,000 worth of deposits per depositor. The thing is that the FDIC, we've already seen during the savings and loans crisis, there was something called FSLIC. And most people might think, what the hell was that? Well, it was actually bailed out and repackaged into FDIC because it actually got itself into approximately 150 billion, 350 billion, I can't remember the exact number now, I'd have to look in the history, of liabilities that it couldn't service during the savings and loans crisis. So FDIC is not, it can only sustain a couple banks going bust because it's approximately, it only has about 1% of the total amount of insured deposits, and it holds them in treasury bills. So they're actually lent to the government. So what is backing this insurance is essentially the credit rating of the US government, but only 1% of all deposits. So if you have one bank, the reason we had the bailout last time is because FDIC just can't sustain one of those banks, too big to fail banks, going. And it's really an illusion of safety in order to make people feel better, essentially. And sometimes it can work, most of the time. But there are black swan events. And when you get a black swan event, some banks have been deleveraging significantly, where they've been just selling off their toxic assets as investment grade to people's pensions. And they're in a strong position. That's why if you look at an investor like Warren Buffett, he's dumping most of his bank stocks, but he's keeping his Bank of America stocks. He knows he's got the inside track on who's actually deleveraged and over-leveraged right now. He's a banking insider and you follow the smart money. The only reason stock markets aren't crashing right now is because everyone is, the stock market is just simply the Federal Reserve market. There is no market behavior anymore. It's just the credit rating of the Federal Reserve. And investors, institutional investors, are not trading economics. They're not investing based upon fundamentals. They're investing based upon the Federal Reserve's ability to guarantee it. We have suddenly entered a market. We're meant to have a market like the US where a tycoon business person is the president. Yet we have said stock markets are no longer allowed to crash. And that's the environment we are in right now. If the market sneezes, then the Federal Reserve suddenly comes along and says, no, we can't have market behavior here. We can't have corrections. We can't allow houses to be affordable to people. We can't allow first-time buyers in. We can only allow, these markets to be propped up. I know that's a bit of a deviation, but to answer your original question, I think it's the second. I think they'll because the lobbying power of the banks is so significant on both the central bank and the government, they'll take it right to the end. And then eventually we have some kind of sneeze in the economy, whether it be credit card crisis, whether it be student loan crisis, whether it be like what we had last time, where investment bankers took over a tiny island called Iceland, and it has a systemic risk effect on the whole economy. But it's such a fragile situation. And then that leads to, I do not think that any depositors are going to lose their money. I don't think bail-ins are a desirable outcome. I don't think bailouts will be a desirable outcome. So I think they'll just switch your deposit over and allow the bank to go bust, and then they'll figure out what to do with all those toxic assets.
But do you think, it's a relevant point about the assets no longer sort of reflecting a real world value. I think the PE ratios, average PE ratio on most of the American stock markets now is at historical highs. So would you say inevitably you must see a correction in asset prices? Even with a digital currency being issued, you still need to actually see that correction to occur before you can start to rebuild the economy?
I see two outcomes. One is that we actually start to three outcomes. We see market forces prevail. That's the Austrian school of economic thought. We ain't going to happen. There's no Austrians in governments. There's no Austrians in, and I'm not an Austrian myself, but with free markets, we don't have a free market economy, but that's one outcome. In order to get back to a free market economy, you need to raise interest rates. You need to allow it to be more market driven. You need to have some kind of way of exercising influence over governments and central banks' balance sheets, which used to be a gold standard. But these are just practically impossible. If you implemented Austrian economics right now, we'd all have probably a world war and violent depression, because I understand that that's how, if we were starting an economy from scratch, great. But we are where we are now. You've got to take where we are. And so it's very well saying this is what we should have done. But what do we do now? So Austrian economics and free markets, I don't think is a viable solution. So then you've got to start looking at what the next schools of thoughts are. We either have monetarism, where we end up with the central banks owning everything and all assets, and a few rich people in a ginormous rich-poor divide, which is the trend that we're going on at the moment. Or we go for Keynesian, and we end up in eventually a socialist, all the capitalist economies become socialist economies in order to try and service some of this interest on the debt to the central banks. Or we end up in just complete China model, which is a quasi-communist, locally global capitalism type model. But we're headed towards 100% tax if we keep on that route. And that's the only real way that you can actually, there's only a few solutions. Or you have a monetary reform and you have a monetary renegotiation. And I think the loser in a monetary reform and monetary renegotiation is privacy. And so that's why I think Bitcoin is so important, because the fiat currencies are about to get really, really horrific in terms of what the impact that they're going to have on our personal freedoms.
Mm. Yeah. Well, I obviously, with that shift to, publicly traded companies and I think private investors hedging, if you want to call it that, into Bitcoin, ultimately is reinforcing that point. But do you think? I mean, there are other assets that resources, gold, for example, obviously is performing quite well. There are other safe haven investments when you have this type of economic turbulence. I think the key is, the ability to transfer wealth between the current system into that asset class is what is important. And I think one thing that Bitcoin brings to the table is custody, the assurance that when you buy that asset, you can custodize it and it's yours. There's no sort of it's not a derivative, it's not a future. It's basically, it actually is physical, although it's a virtual asset. But in the context of ownership, I think that, as well as gold, obviously have the same sort of characteristics as a safe haven investment. Where do you think the overall, where do you think the from a time frame perspective, it starts to get interesting? I mean, we are going into a deleveraging cycle. Effectively, what you're saying is that the digital currencies will be a form of deleveraging. It's a case of, as the debt goes, basically has to be replaced with the new monetary system. You see that as the way that it gets introduced?
Yeah, absolutely. If you try to deleverage the economy right now and return the money supply to something without the leverage in it, then literally we'd all be in poverty with a few very wealthy people. And it wouldn't be a very desirable outcome by any stretch of the imagination from where we are right now. It's why for me, although, I've positioned myself to benefit in such a scenario, but that's not a desirable outcome for anybody, because the reason I want fiat currency to be better is because fiat currency is, if we have a banking problem, that affects my grandma, that affects my mom, that affects my sister, that affects everyone we know. So for me to want the destruction of our financial system in order to benefit something, and this is what we see with a lot of people that own gold, for example. So the whole gold example, I think gold is no doubt is a store of value. Bitcoin's what I call a speculative store of value, which it means it has the potential to be a store of value. And therefore, because it's not a store of value yet, you get to have asymmetric returns, which can beat the hell out of any of your gold portfolio, from my perspective. But gold is what you do when you're trying to preserve your wealth, when you've already got wealth. Bitcoin tends to be a speculative store of value where people are trying to generate wealth on the belief that it could become a store of value. These two are actually very, very complementary, because one thing we saw during the lockdown, and you talk about the difference between physical gold and paper gold. Well, the size of the paper gold markets, the gold futures markets, the gold ETF market, all the different products, none of them are backed by physical gold. There's significantly more paper gold than physical gold, which in itself is a ginormous issue during a time like this, especially when you move into what we saw during the last lockdown, is everyone was trying to claim their physical gold on their paper gold, and the supply just simply disappeared. And that's when you have a run on some of these custodians as well. So if you can't get on a plane, everyone's storing their gold in Switzerland and Singapore and various different places, Australia as well. If there's not enough physical gold to back that paper gold, therefore you have real issues holding things in custodians. The time you need your gold the most is the time we're probably in lockdown and you can't get on a plane, which is why the ability to be able to store something in an easier way, because it's digital and doesn't have bulk and size, has its upsides in that scenario. And that's why gold and Bitcoin are so complementary. And this whole gold versus Bitcoin argument is actually quite futile.
Simon, can I quickly get your thoughts just on the subject? Can I get your quick thoughts on the FSA ruling last week on Bitcoin derivatives?
Yeah. So the FSA has always had a bee in its bonnet for all types of spread betting and contract for different products. They're not actually a product that's is actually illegal in America already. They have derivative products, but they don't, because gambling is illegal in countries like America and China, unless you do Las Vegas and Macau. Then these financial instruments were actually the reason. So in countries like UK and Australia, They have these derivative products that are tax-free and tax efficient because they are actually considered a bet, a spread bet, rather than a financial instrument. And so the FCA has always had a bee in their bonnet about these spread bets and contract for difference products because they're mainly targeted at retail investors. Retail investors come along, they deposit some of their funds, and they just disappear because they just get wiped out in seconds. And so retail have always had lots of complaints to regulators. Now, can you imagine accelerating that with the volatility of Bitcoin? You can imagine how many people get wiped out from these derivatives, and then take that a little bit further when you have companies like BitMEX that are allowing for 100x leverage, and not even identifying who the customer is, so that you can end up with Americans and Chinese people where gambling might be illegal, engaging in these different financial products. So the UK has made a specific target. What I've seen from UK regulators is they're not so against the crypto markets. In fact, they put together pretty interesting innovation and regulation for the financial institutions that want to do things. But the derivative side, they've decided to put their foot down and take a stance and said, this is not a product for retail, and we think it's harmful for retail. So we think the best approach is just to eliminate.
Yeah, it's an interesting one, isn't it? Because a lot of sort of Bitcoin maximalists never really wanted to see those derivative markets in the first place, anyway. So
we are going to have, you can see the writings coming. With the paper, with all the interesting thing about DeFi is that the ability to actually do this outside of the companies in the middle creates a really, really interesting next move there. Because you can see with Bitcoin where we're going, the lending markets are exploding, collateralized loans are exploding, and those are being done through centralized companies that might be engaging in fractional reserve and might be recreating the entire system again. We saw it with gold. We're seeing it with Bitcoin. I think we're going to have more paper Bitcoin than Bitcoin seen. It's exactly where the market's going.
Simon, you mentioned, with central bank digital currencies that there are obviously pros and cons. And you on your last podcast, you talked about, automation of tax, automation of interest, negative interest specifically, algorithmic monetary policy being implementable with a digital currency. I mean, the ability for direct stimulus to citizens. When you weigh those pros and cons, obviously there's controls that the government can mandate as part of being a recipient of a digital currency. But when you weigh the pros and cons, do you see it as being more pro or more con?
I think it's a pro for your everyday expenses money and a con for your savings. So I would not store any large amount of wealth in a central bank digital currency or any fiat currency. And it's why everyone's driven to the markets with their savings, because it just doesn't make sense. The only good things that you can do with fiat is maintaining a balance of whatever you consider your safety bucket for meeting your expenses without the volatility of having to liquidate assets, which might not be the right time. And also debt, the winners of these trends are the largest debtors. And the government being the largest debtor, and they're devaluing their currency so that their debt is worth less in the future, so that they have to repay less in the future. And that's why it drives people deeper and deeper into debt. And that is the vast majority of people. So, you can't really put everyone in the same category. If you are living month to month on a credit card, which is the vast majority of the population right now because of this system, and almost all of your money is going to rent or servicing your mortgage, then you don't really experience the pain of not owning your money, not being able to spend your money and send it freely. And you're probably benefiting from the devaluation of the currency as well, if you're in debt. But if you're a saver, that's when you're shafted. So it's the older people, it's the people that have been saving, it's the people that are actually doing the responsible behavior of spending less than they earn and investing the difference that get harmed by these fiat currencies and policies.
Do you think because of fractionalization that is given ability to be implemented because of digital currencies, or sorry, digital assets. So I can issue a digital security. I can have fractional ownership of real estate, and you're seeing a lot of those sites now starting, those platforms emerge around the world. My company Skyhook, we're looking at doing projects allowing for fractionalization of proven reserves. So you can actually take ownership of gold in the ground as a proven reserve, obviously purchase at a discount to spot, and then through a governance structure that's being managed by the issuer, rather than take risks owning the mining company itself, you have direct ownership over the reserve. I mean, this is going to give, I think, an audience that previously did not have enough money to go out and buy, say, a house, now be able to put $10,000 into a global property portfolio spread across fractional ownership in markets around Australia, Europe, the US, for example. And the problem about, I mean, if you think about loans and interest rates, it's all based on what collateral you can put on the table. It's the quality of the collateral that determines that, what sort of interest rate you're going to get. And I just think the market has been closed off to low income earners because they haven't been able to accumulate enough capital to get the quality assets. Digitization actually allows them to do that. Do you think that is a path forward?
Yeah, so we were talking about monetary policy and debt. Now moving over, shifting gears slightly to savings and investments. Savings and investments is where we real growth can only be stimulated by savings and investments and people creating things. That's the real solution to where we're at, and we're not having enough of that. And so if by having financial inclusion, it allows us to open up markets to a much wider audience. The interesting thing about the crypto markets block is, say what you want about we talked about the ICO bubble and regulations and scams and all stuff like that. There were just, an incredible amount of scams and all sorts of stuff. But what I did like about it is young people that were on the path to go into university, taking out excessive debt, getting a good job, taking on credit cards, getting a mortgage, and they were stuck in the rat race of the debt cycle because they did everything that society says you should be doing. They, for the first time, the young people that were actually, this is the generation that were never going to be able to own their own property or real estate. Sorry, if you're from the different countries. The crypto markets for the first time attracted a really young audience to actually start thinking about money, speculation, savings, investments. And while many of them were scams and all sorts of stuff, at least for the first time, these young people in that generation were actually thinking about investing. And for whatever reason, this has captured the imagination of that generation. And so now, even though you can have, with the internet and digital technology, you can have crowdfunding platforms that allow for being able to invest with very small amounts of money. You don't necessarily need a blockchain to achieve that goal. But there's a lot of really interesting innovation that's coming out of that, and allowing for, people in different countries globally to be able to that. The thing that's holding that back is just fragmented regulations. We spent the last 10 years trying to allow certain investors that can comply with their local jurisdictions to invest in financial technology companies at Bank to the Future. The amount of challenges are not technical challenges, they're all compliance and regulatory challenges. And so really the cryptocurrency market does not necessarily change some of those unless you can do things in a different way, which is why if we can come out at the other end of this DeFi situation, that we have more participation, more democratization of investment, and more financial inclusion, then I'm all for that.
So what role do you think banks are going to play, if any, in the future? Because to me, it looks like the death of a thousand cuts. You've got, in trade finance, in collateral management, You could look at lending being automated through DeFi. I mean, if you were to sort of look 5 or 10 years down the track, what would a bank look like?
So I think we're gonna the environment's gonna move in two ways. I think we're gonna have a really buoyant, interesting self-custodial model that develops, and a custodial model, because regulations will force everyone into a custodial model. But that doesn't mean that we're not going to have the booming market. So when I'm investing in this market, I'm looking at investing in both sides of the industry, because I think both are going to boom. I do think a bank has a role. The thing with the banking system is we need a monetary reform, because we have systemic risk in the system. But once you replace debt-based money with debt-free money, then you have a market for every single product. We've seen it in Bitcoin. You have a different monetary system, and then everybody builds financial products around sound money. You can have the same thing with a central bank digital currency, where it's non-debt-based money, and then banks can build all sorts of products around that. But I think that banks are, the writing's on the wall in terms of we need the monetary renegotiation will favor the banks, because the inevitable, the system is at the end of a debt cycle. Banks don't survive that. So we need to have some kind of monetary renegotiation and a new system. And banks are just going to be technology companies building on top of a central bank API. That's all we're going to be in the end. There's not going to be branches. There's not going to be human contact. It's just going to be technology.
Do you think that in terms of managing the macroeconomic picture, do you think the central banks themselves will become more AI driven in their decision making?
That's an interesting question. Probably everything's going to be becoming AI driven. That's an inevitability of where all these trends are taking us. So I don't see why a central bank wouldn't be subject to similar policies as well, particularly when the next generation starts becoming the leaders of these central banks as well. And yeah, I think everything is going to be AI driven in the end. That's just inevitability of where everything is going.
Simon, question. I've obviously been doing my best to educate people on Bitcoin specifically and blockchain as well over the last 4 years. You've been there right from the start. As an educator, what would you like to say to regulators at the moment?
Well, I mean, that's an interesting question. I think that every country at the moment needs economic growth, and every government needs to stimulate jobs and needs to stimulate growth. Countries like Japan have been looking at how they can create progressive regulations for our industry. But the main message well, it's not really regulators, because they're just enforcing the policies of government, but sometimes they overstep the mark, and they actually start to regulate things that aren't written into law. And so really it's more of a legislative thing, because the regulators are meant to be just enforcing the laws, and laws are meant to be determined by a democratic process from lots of case laws that happen over time. And so really the message is for governments, that governments have a really, really interesting opportunity to really have just a ginormous shift in terms of their power play at the moment. I really believe that if I were a central bank, if I were a government, or if I were a distressed country like Lithuania right now, or something like that, where my currency is being destroyed, then I would be allocating some of my electricity of the country to mining Bitcoin. And then I would be trying to get first to make the announcement that we're now holding some of our reserves, not just in treasuries, not just in gold, not just in dollars, but also Bitcoin. And that announcement alone can actually trigger off a countrywide FOMO situation, where the last central bank or government to adjust to that ends up in the wrong side of a really big power play / currency war. But at the moment, I'd be encouraging, governments and regulators that your people deserve the freedom to be able to choose. And if you really believe in your policies, if you believe that your policies are right for people, then allow them to choose and create better fiat currencies. create really great fiat currencies, and no one will use Bitcoin. Or, allow people the choice, because, if you actually exercise, if you gave people the ability to own their own money, spend their own money, and have a fixed money supply, I understand that it's not right for your economy, because that's very challenging to manage an economy on such economics. But at least give people choice, and freedom to choose is what I think the great result of this is. And that's what we need. So no draconian blanket bans or anything like that, because eventually, we've seen what effect that has on countries that have tried to do things like that with gold. The whole country ends up servicing the gold markets. You end up shafting your population because you purchase all the gold at $35, and now gold is $2,000, and you shaft your people out of that. There's a wealth effect. I would encourage people to start looking at not the status quo of stimulation based upon debt, but stimulation based upon savings, and how you can introduce a money supply that allows for people to actually really redistribute savings rather than stimulating on Ponzi schemes.
Fantastic answer.
Yeah. Agreed.
One similar question. As someone that's been educating people on Bitcoin for 4 years, one of the main things I would say is listen to Simon. The link to his channel is below. But Simon, what do you think the main message I and other people doing what I do should be getting across to the average person, specifically about Bitcoin?
Yeah, so it's a really challenging one, but really, I remember when I first got my first Bitcoin and used it, and there was an incredible sense of power and freedom when you actually just buy some Bitcoin, figure out how to own it, and then just send it to someone, even if you're sending it to yourself. Just getting over that step, that first hurdle, is anything, anyone can do that. I understand that there's technical barriers. I understand that, but at the end of the day, most people figured out how to use a computer. There was huge technical barriers in that. But once you did it, you realized how much of an impact that can actually have in the way you do things. So really, it's just, I think it's about people making that first step. And then the real problem within our industry, and I don't know if it's a problem, a feature, or a bug, is just the crazy infighting. And this really brings us to your podcast, the hard forking concept. And I don't think there is a solution to that, because at the same time, the accountability in our industry is driven by, people being able to say what they want, whatever they want, and do what they want. And really, that is something that I think should be encouraged. Competition is good. Competition is not bad.
I agree with you. I think you're quite unique. I mean, obviously, I came across you on some of the sort of the hardcore Bitcoin channels back in, I think, 2016. But I've also recently heard you say that, you're kind of silly if you're not looking at all the innovation on Ethereum and so forth, and you've left a lot of money on the table, basically, if you're playing the investment game in the space. Could you maybe sort of talk us through your thoughts on Ethereum now specifically, and some of the better things you see happening in that space?
Yeah, so again, I got to put on a couple of different hats, because the complication about these conversations, I've been putting in the politics hat, the investment hat, and my thoughts of what's going to happen in the politics is not necessarily where it's going to go or where I'm going to put my money. So when I think about what people need to do, and I'm actually in the next few weeks, I'm going to be releasing a full video series on exactly how to invest in the Great Depression of 2020. And going through, but essentially you need to
$1 million of your own money, I believe, as well, which is going to be fascinating.
Retirementplanb.com, I'm going to be releasing a video series, and I'll be putting $1 million showing what I would be doing from scratch in today, because I get a lot of people that say to me, you were there from the beginning, I'm too late, and I try to say to people, well, no, I'm still active in the markets. You don't just sit back. So if I was starting from scratch today, here's exactly what I would do. I'm pretty conservative at the same time as willing to take some very risky bets. But I don't take all of my money and put it on a risky bet. I have a traditional portfolio that will benefit from US dollar and traditional assets, all maintaining the status quo. I have a Bitcoin-based retirement plan, which is based around accumulating as much Bitcoin as possible. And in order to do that, you have to take some kind of risk-managed approach in the wider crypto market. So Ethereum was an interesting one. It was funded by the Bitcoin community through an ICO. You could only invest Bitcoin in Ethereum when it started. So people forget that this was actually a Bitcoin-funded innovation. Yeah. And it was funded by the Bitcoin community. And the challenge with Ethereum is it can do things that Bitcoin can't do. That's clear. But you have an immense amount of complexity in it. So my full-time job is to understand this industry and the trends. And yet I still don't understand Ethereum 2.0. You know, what hope has someone else got of understanding that? Now, I'm not a developer, I'm a finance guy. So some of the more technically savvy people I rely on to kind of help me navigate through that. But Ethereum is extremely complex. You know, a simple question, what is the supply of Ethereum? I think you get a different answer from anyone you speak to, and no one can really answer that question with a straight answer. So, you know, Ethereum is something different. It's not sound money, but it is got an incredibly buoyant developer community that is really, really impressive.
I don't know if you've seen it, but I've launched the show on Wednesdays because obviously I've been, you know, just covering Bitcoin for a number of years now, and a number of my friends were like, for God's sake, you know, you've got to look at everything else happening in the space. So I've gone and been in the deep end, and where, you know, we review projects on a weekly basis, and you know, there's so many things happening. It's literally on the weekly. You've got to learn something new. It's an amazing space at the moment. Lawrence,
finishing on that, there's too much happening that's being built on Ethereum for anyone to keep up. So for me, it's simple. I will own some ETH in order to try and benefit from a network effect that's being that's happening there. And if you want to gamble on some of these crazy tokens and DeFi tokens that pump and dump thousands of percents in days and stuff like that, then just do that with money you're willing to lose, and just know you're sat on the chips on a gambling table, and only do that with the portion of your crypto that you're willing to actually put on the gambling table.
Yeah. So Simon, obviously the institutions are coming into Bitcoin now. We've had microfinance recently come in with a large play. You've been there right from the start. You know, you spoke at the first ever Bitcoin conference in Prague. I believe the people there were sort of wearing, you know, the anonymous masks and so forth. 10 years on, is Bitcoin now what you kind of thought it would be? What's the major sort of surprises for you? Or
Bitcoin has superseded all my expectations at that time. You know, this was at that time, I was in a pretty bad place in terms of I was part of a community called the Monetary Reform Community, and there was no hope. You know, we were trying to persuade bankers and politicians that they need to reform the system that they're benefiting from, because it's not going to be sustainable. And it was, you know, I remember going to like these meetings where it'd be, you know, nothing against pensioners. I got a lot of respect for the wisdom of elderly people, but the Monetary Reform Community was a bunch of non-tech savvy, you know, elderly people that were concerned about their pension and savings. And it was going nowhere. It was pretty depressing. Bitcoin came along, and suddenly there was this channel of hope that we didn't need to speak to politicians. We didn't need to get banks to change anything. We could just create a financial system that exists outside. And I had a lot of hope for that. And because I was trying to do something, you know, build something in that space, it was really, really like a solution to a problem that I wanted to exist. But I didn't really think that we would ever get this far. But now, you know, people talk about how slow Bitcoin adoption is, but I can't believe in a decade, something that nobody had ever heard of, that was just a handful of people in a room, now pretty much every person in the world have heard of. They probably don't know what it is. They may not have engaged with it. They probably think it's a currency just for drug dealers, a Ponzi scheme, a scam, or a get-rich-quick scheme. But the fact is, we're now at the phase where everyone in the world has heard about it. Now the institutions, I think the next bull wave is coming from companies that want to put, you know, what a brilliant strategy. Take 1% of your millions that you've got on reserves as a public company and hold it in Bitcoin.
Absolutely.
You know,
Lawrence, maybe we tag you in here because this is sort of where you're
Look, I think the only thing that probably is on par with this level of spread was the PC revolution, right? I mean, we went from having zero ownership of PCs to within 10 years, everyone having one on their desktop. So it is an amazing proliferation of a technology, which then has, based on that, a lot of derivatives. In the case of the PC revolution, it then enabled people to connect to the internet and be able to, through their browsers, gave rise to e-commerce. I think we're seeing the same sort of network effect now playing out with Bitcoin. I think Ethereum's got an amazing future. The capitalization of all these DeFi projects that is now bringing that into the Ethereum platform, and therefore the whole crypto space, is laying the groundwork for, eventually the global financial service infrastructure being replaced, within the next 10 years by distributed ledger technology backed protocol. Ethereum's probably got a great chance of being the world computer at this rate. I know there are several other contenders out there, Sean. We've gone to those conferences as well. But, when it comes to adoption, we can always refer to the Betamax versus VHS story, right? If you're the one that's being adopted by the market, regardless of technical superiority, adoption is key. And Ethereum has got adoption. Bitcoin obviously has its place in the market. There's a few other cryptos out there that look very promising. Chainlink looks fantastic because it's becoming the integration standard between the sort of, shall we say, the existing world and the crypto world. There's some powerful solutions that are being developed in the crypto space right now.
Okay. I guess sort of the last subject I really want to move into here, Simon, can you tell us a bit more about yourself and what the average person needs to be doing at this point in time, in your opinion? Obviously not financial advice, we're not allowed to do that. Yeah. But if you could talk to us about, we've covered sort of the institutional players here and a lot of the bigger picture macro stuff, but the average person here who really is worried about their future right now, what are some actions you think they can be taking, and where should they go for information?
Yeah, again, I used to be I did all my financial advisory exams and all that stuff, and one of the challenges with financial advice is you really need to have an individualized conversation, because good advice for one is bad advice for another. It depends on your goals, when you retire, what your obligations are, what your liabilities are, and so we can't give financial advice. But one thing I think that everyone should do is really think of, and I came up with the retirement plan B because everyone needs a plan B. And so people can start thinking about, well, what if my plan doesn't work out? It doesn't mean that you have to completely take away your existing plan, keep that there, but start putting some of it into a plan B. And I think a responsible plan B is, what do you do to benefit if the traditional financial system doesn't work out the way that everyone thinks it, or what most people think it will work out to? So really, I think that, and I hope that there is another rehypothecation to maintain the status quo. There are ways of benefiting from that, but you also need a plan B of something that exists outside the financial system. And unfortunately, one of the goals of the video series I want to create is just helping people understand that there are 5 seasons you need to prepare for. There's inflation, there's deflation, there's economic growth, there's economic decline, and there's a systemic risk in the banking system. And if you can prepare for all of those, and there are simple ways to prepare for all of those, then you really can just sit back on the side as an observer, and one of your portfolios is going to work out. The challenge with this is that most people have relied upon fund managers to do that for them, and there's reasons for that, because the immense amount of complexity, not in the traditional financial markets, is immense. The barriers are just so high, and that's so that you can hand over your money to people that can take that complexity on for you. Combine that with technology, and then you've got the Bitcoin markets. You've got incredible complexity in finance, incredible complexity in technology. I mean, it's really, really overwhelming. So really, it's about, one of the things I'm trying to achieve next is just simplifying that for everyday people that can actually just really start to think about, well, if this scenario goes this way, what effect does that have on my future? And you need to be prepared for that. I'd love to say just hand it over to the financial system, but I don't trust the financial system to look after your personal affairs because the conflicts of interest are there. All the regulations in the world can try and resolve that, and they have gone a long way to try and deal with some of those conflicts. But some of the conflicts are just systemic, and you need to start thinking of yourself and start actually planning some of your own things. So the one thing I think people, if they could get one thing, is recognize that no matter what you do, you are speculating. If you leave your money in a bank, you're speculating on the credit risk of the bank and the credit risk of the mortgages and the debt markets that they're propping up within that bank. If you're just putting it in an index fund, then you are making a bet on the status quo, on the Federal Reserve pumping money into markets. And if you could just understand a little bit behind the speculations that you're making, then you might actually make different decisions, and just appreciate that if you're not going to speculate for yourself, you're handing your money over to someone else to speculate for you. They might do a better job for you, but put some of it into actually learning how you're going to protect yourself.
Excellent answer. Lawrence, any closing questions or comments?
No, I would just, I would say from direct experience after servicing, providing platforms basically to a lot of the traditional wealth management institutions, globally. I agree with Simon's comments there. A lot of them have been driven in the last, 10 to 20 years more from either trying to minimize your tax or trying to sell your products to maximize their fees. And ultimately, the returns to the investors have not been great. And because of that, you've now seen the rise of non-bank wealth management institutions, family offices, independent financial advisory firms. So I think it is very much now a specialized area. And I think also because we are heading towards one of those sort of tectonic shifts in what's happening globally with the financial service infrastructure, the monetary system, you need to be more creative in your thinking about how to manage those investmts. So yeah, putting it into an index fund, it's risky business. We're heading into what you would call dark clouds right now, Sean.
Absolutely. So Simon, we thank you very, very much for your time. I think you're one of the premier thought leaders, both in the crypto space and from macroeconomics in general. It's been an absolute pleasure talking with you again. There's links below to check out Simon's content. Strongly encourage you to make him a regular go-to. You're making some fantastic content. I see you popping up on a lot of sort of mainstream media channels now as well. That's great to see. So thank you, sir, for your time.
Okay, thank you very much for having me. And yeah, leaving you on a positive note, everybody. This is one of the most interesting times in financial history. So there is some really dark stuff happening, but there's also some really positive stuff happening. And you've got to decide how you're going to get on the right side of that. So there's a yin and a yang to this. There's lots of, if you watch a TV, there's lots and lots of really horrible things happening. But on the other side of that, there's a massive amount of innovation that's coming. And we got to come out the right side of that, and you need to decide which side you're going to be on. Exactly. Very true. Yeah, it was great speaking with you again, Simon, and enjoyed it immensely. Okay. Thank you, everybody.
Excellent.
Take care.
Thank you for watching, everyone, and we'll see you all soon. Cheers now. Bye-bye.